Welcome to another edition of Meet the Visionaries podcast, sponsored by the MIT Center for Real Estate. Today we're going to go on a fascinating and inspiring journey featuring Jamaican national Ms. Onay Payne, a senior managing director and portfolio manager at Manulife Investment Management. The conversation today is led by our very own Mr. Viet, Nguyen, a current MSRED student in the Center for Real Estate. And so I turn it over to you, Viet. Take me on the journey.
Hello, I'm your host for this episode, Viet Nguyen, and I'm here today with Onay Payne of Manulife Investment Management, the asset management arm of Manulife, a global financial institution. So Onay is a senior managing director and portfolio manager on the global real estate leadership team at Manulife and is responsible for driving ESG strategy and development. So welcome, Onay. I'm really excited to have you on the podcast here today.
Viet, I am so excited to be here with you and really appreciative of the invitation to join you.
Let's start from the very beginning for you. So could you talk about your background and your career journey and how you ended up at all the way until how you got to your current role at Manulife Investment Management?
Okay, you want me to go way back?
Yes,
back? Okay.
Yes.
All right, so the earliest, so just because it's informative of why I'm here today is that number one, I'm an immigrant to the US. I was born in Jamaica in the West Indies. I moved to the US, my parents moved to the US when I was about 4 years old. Being an immigrant informs the way that you live your life, right? Particularly when you come from a place that has much more limited resources than you might have in the US. And so we moved for a couple of reasons. Education, my dad wanted to pursue a master's degree, a couple of master's degree that were not available in the West Indies at that time. And my mom was a registered nurse, came over for work. But really the intent with them moving to the US was ultimately to support greater levels of socio-mobility for them and then for my sister and I, right? So I grew up in Long Island, went to public school. There was no excuse to not do well with the resources that were afforded us. So I did well, right? My sister did well. I went to good schools, including Harvard College and Harvard Business School, which opened up incredible doors for me. But ultimately, the reason why I'm really here is because in addition to working hard, I was exposed to different pathways through the Inroads program and through my TWIGO fellowship. So these were both fellowship programs or initiatives focused on increasing the representation of talented minorities in financial services. So through the Inroads program, I summered at JP Morgan Chase. Back then it was Chemical Bank for 4 summers, starting in the community development group. And then I ended up in the investment bank during my last summer in the aerospace group. And then I worked at JP Morgan for 4 summers for 4 years, before business school. And an incredible really foundation as a financial professional, as an analyst and then associate at JP Morgan. I then went to business school and received a TWIGO fellowship. And then through TWIGO was afforded the opportunity to get additional soft skills training, some harder skills training, but even more importantly, exposure to a network that showed me that my interest in investment management, there were paths that I had not even considered, right? So I knew investment management was interesting to me, but I didn't know real estate private equity was a pathway that was possible, that existed actually. I had bought my first apartment when I was about 24 years old, and this was in Brooklyn, New York, and Fort Greene, Brooklyn, which is now around the corner from the Barclays Stadium, in a blossoming part of Brooklyn, part of New York. And as I thought about the things that were most interesting to me personally, the opportunity to mix that personal passion with what I could do professionally, I was able to uncover through the TWIGO program. So through TWIGO, I met a mentor that ultimately facilitated my discussion with Clarion Partners, and I started a 20-year career, almost 20-year career at Clarion right out of business school. So I started in asset management and was really focused focused on starting in asset management so that I could understand how value is created in the real estate industry. I'd gotten a lot of analytical and quantitative training in banking, but I really wanted to understand how value is created in real estate. So asset management, I spent about 1.5 years, 2 years there, got to understand multiple property types throughout the Northeast. And then I moved into our acquisitions group, focused on the Southeast, again, multiple property types. So I got a bunch of reps in terms of underwriting, and then ultimately was presented with an opportunity to lead the underwriting for a Mexico focused initiative. And I'd spoken Spanish fluently from the time I was in undergrad. I had done a semester in the Dominican Republic. And so it was a great confluence of, again, personal interest and professional opportunity meeting. So I ended up leading the underwriting for our Mexico initiative, and then was afforded an opportunity to help manage a Mexico-focused vehicle, a closed-end fund. Initially, we had thought we were going to invest in Mexico through existing vehicles, but the opportunity grew, and we ended up raising a $650 million equity fund. The only catch, Viet, was that I had to move from New York to Dallas in order to take that position, because we were managing the Mexico business from the Dallas office. So I packed myself up, because this type of opportunity doesn't happen every day. And I moved to Dallas. So it was an incredible opportunity where I had direct investor exposure. I managed a team in the US and in Mexico that was focused on both the underwriting and asset management. It's a challenging place to do business, I will say, anywhere outside of the US where the legal systems are not as robust from a rule of law and contract enforcement perspective can make investment challenging when things go wrong. So I got a lot of experience in restructuring, arbitration, civil law, and criminal law. So I feel like I have an honorary JD in Mexican law. It was, it was really great in terms of giving me an opportunity to grow and understand how to be a fiduciary when things aren't going right. Because of that experience, I was able to make partner in a more than reasonable time, and I was able to continue growing with the firm. And I would say one point of continuity throughout my career was that I had the opportunity to continue learning, growing. As soon as I felt like my learning curve started to flatten, the firm presented another opportunity. No one gives you anything, you got to work hard for it, but there was an alignment with working hard, the firm recognizing it. So the next opportunity, as we started winding down the Mexico vehicle, was to come back to New York, work with a large separate account client for the firm as one of our partners retired, and I started reinvesting in the U.S. and all property types, and office and retail, in multifamily and industrial, utilizing the robust infrastructure of our team. By the time I left Clarion in 2022, I was also working, in addition to institutional clients that I was managing. I had an opportunity to work on some of our retail investor-oriented vehicles that really were a great opportunity to be part of the democratization of access to private real estate. And so I ultimately got to work on a vehicle for the first time that I could get my mom and my dad and my sister invested in. But in 2020, with the advent of certainly social unrest after George Floyd's murder, in the midst of the pandemic, I started to feel an urge to do something professionally that even further aligned with my personal passions. So how could I, from a position of privilege, having had an opportunity to have this great career in real estate, private equity, think about utilizing my experience to support additional change? How could I think about supporting greater levels of institutional investment into places like Hempstead, New York, which is where I grew up, where, I went to the right public school that had advanced placement classes, but, outcomes could have been really different for me if I'd gone to the public school that I would have been zoned in a 10-minute walk away from my house, right? Not as much opportunity. So I really wanted to think about how I could support change within our industry. So ultimately left Clarion on really great terms, but to pursue more impactful investing strategies. So I spent a year and a half at a group called Lafayette Square, which is really a credit platform that's focused on for-profit impact investing. And I was building out a real estate private equity strategy for them. When Manulife came knocking on my door, I saw an incredible amount of alignment between the things that I was personally passionate about, alignment between for-profit investment strategy that I was working on at Lafayette, and the things that were important to Manulife as identified in its impact agenda. And so I couldn't turn down the opportunity to really be part of, leverage what was already a really robust infrastructure with respect to ESG and ESG integration, the potential for working with Manulife's balance sheet, and then also the potential to be part of a really huge shift in the way that Manulife was running its business, shifting away from GA-focused investing to really third-party investment management. So that led me here in 2023, and excited about the work that I'm doing with my partners here at Manulife.
Oh, wow. That's an incredible journey, Onay. Like the amount of exposure you've had, like great career. Could you expand a little more on like what your role at Manulife encompasses and how it fits within the global real estate team and the whole Manulife as a whole?
Yep, sure. So I'm a member of the global real estate leadership team, and I'm specifically tasked with building out our private markets real estate impact platform. So I'm focused on developing an investment strategy which enables Manulife to effectively expand on its commitment to sustainable investing via a commercially driven, meaning profit-driven real estate investment strategy, which first leverages Manulife's really industry-leading ESG processes and infrastructure. Second, aligns with Manulife's global priorities and does that through asset-specific, hyperlocal execution of those strategies. And then finally, prioritizes positive environmental and social impacts alongside, not at the expense of, but alongside market rate returns. I want to make it very clear, I'm not a sustainability practitioner, but I am a returns-driven investment manager and really an advocate of conscious and inclusive capitalism. I leverage the expertise of our sustainability practitioners because I believe as private investors, we must more actively integrate environmental and social sustainability considerations into our investment decisions to, number one, mitigate investment risks. So that's obsolescence risk, regulatory risk, and reputational risk. And then also improve risk-adjusted returns over the medium and long term by reducing operating costs and improving tenant attraction and retention. And if I may, I'll just give you a few examples of how we think about that from both the environmental and social perspective. So from the environmental perspective, we're thinking very practically about reducing operating costs, landlords' ability to operate buildings more efficiently, using less energy over time, potentially lowering energy costs. That directly translates into higher net operating incomes in the short and medium term. We're also seeing improve tenant recruitment and retention through environmental initiatives, particularly as tenants are starting to or increasingly prioritizing buildings that are energy efficient and free from fossil fuels and powered by clean energy. Many of those tenants now need to report on their scope 1 and scope 2 emissions. And so the buildings that they occupy, they need to be able to understand what the carbon footprint of those buildings are. There also appears to be an increasing tenant willingness to pay higher rents for green and healthy buildings. For example, in the office sector, we know that particularly post-pandemic, tenants want to be in healthier buildings with great ventilation, with good light, and those things translate into greater employee well-being and productivity. Studies have shown that healthy businesses can really help tenants attract and retain employees. It leads to those employees staying in their jobs longer, them being more engaged, and being absent less. It's reasonable to assume that those positive attributes will not only translate into long-term value preservation, but also value creation when those sustainable investments see premiums in rents and improve operating income and cash flow over a hold period for an asset. And then also at exit, we see deeper buyer pools willing to pay potentially lower cap rates, and then translates into higher valuations. So those are some of the things that we think about from an environmental perspective. From a social perspective, we believe there is a clear economic rationale for profit-driven investors who invest with an inclusive growth mindset and who invest with more socioeconomic outcomes in mind. When I'm talking about inclusive growth, it's really the investment philosophy that posits aggregate demand. So, what contributes to GDP growth. It's most sustainable when it's broad-based, when more people get to participate in it, and when we are reducing economic inequality. So if we look at the US, right, long-term GDP growth has been healthy, but it hasn't benefited all groups of society equally. Growth has disproportionately favored higher income, higher net worth individuals who have higher paying jobs, but also are able to benefit from wealth creation related to home and financial asset ownership. And really what we're seeing is that socioeconomic inequality in the US is as high as it's ever been. It has continued to increase, and it's at record high levels over the past 5 years. Research suggests that if we can decrease socioeconomic mobility and persistent disparity, we can support economic growth that is broad-based. So if we can think about investing in a way that yields more equitable outcomes and supports really the growth of a strong middle class, that correlates, and this is why it makes sense from a real estate perspective, that correlates directly with employment growth, with income growth, with household formation growth. All of those things drive consumption of goods and services, which in turn translate into demand for real estate, right? Mm-hmm. So if we can support greater levels, not just socioeconomic stability, but also mobility for lower income households to boost into the middle class, and for middle income households to increase their earnings, we can really potentially boost broader economic potential and real estate demand, particularly if we think about addressing the undersupply that exists with respect to attainable or affordable housing and other goods and services. So as you can tell, I'm incredibly passionate about both these topics. I'll stop for a second.
Oh, no, that was really good. No, I totally agree. I think ESG is unfortunately in some certain news outlets, I feel like it's really taken a hit. And how do you see like moving forward? How do we continue to advance these like environmental, social, and governance goals that we all have for to better society?
Yeah, the increased politicization of climate change and ESG, from my perspective, is just it's counterproductive, right? I fully understand that there are fundamental economic interests associated with keeping, for example, the fossil fuel industry thriving, but it is indisputable that 2023 was the hottest year on record. Indisputable. It's indisputable that the number and severity of billion-dollar climate events has been rising sharply in recent years. There were 5 times as many billion-dollar climate events in 2023 alone as in all of the 80s and 90s. All of the 80s and 90s. That is mind-blowing. So to not consider ESG factors in most businesses and governments' investment strategies is simply irresponsible. Should consideration of those factors alleviate investors of their fiduciary responsibility? Of course not. But we need to take ESG risks seriously. We need to identify them. We need to analyze them. We need to mitigate them and then communicate them with transparency. And so we need to remove the noise from this anti-ESG and anti-woke movement. And as business leaders, we need to find the evidence or demonstrate the evidence that we don't have to bifurcate our fiduciary responsibility and our societal responsibility to support more, to support better environmental and social outcomes.
Mm-hmm. Yeah, I've heard some people say they think they should split like ESG into like different verticals because they have like different like performance indicators. I just want to get your thoughts on that and how you or Manulife would feel about that.
Yeah, we definitely need to think about each of the specific metrics that are associated with our investments. We need to, KPIs as you would have in any other part of your business, and each business would have different KPIs. So we need to develop, define, track, and then report on KPIs that are unique to the impact outcomes that we're looking to achieve. So the KPIs that I would think about from a social perspective would be different, but I would suggest interconnected with some of the environmental KPIs. So if I think about my desire to yield greater levels of affordability, to be a participant in delivering affordable supply into the market from a housing perspective. So I'll be looking at the metrics that are associated with the units delivered and units preserved. At the same time, there is an environmental consideration for those units. If I think about particularly the opportunity to for older stock, which may not have been as tapped from an environmental sustainability perspective, I need to think about my ability to underwrite the, for example, decarbonization potential, or think about other sustainability metrics. So my ability to decarbonize a building by 30% over a specific time frame is a different metric than the metric that I'll track in terms of units that I deliver. But for me, there's an intersection. But to your original question, yes, we need to be very deliberate and clear about each of the metrics that we're tracking, based on the outcomes that we endeavor to achieve over time. And those will be different from an environmental perspective, social perspective. They'll also differ from an asset property type perspective as well.
Mm-hmm. So I guess building off that, what are the strategies you're working on at Manulife to bring this to fruition?
Yeah, so as I mentioned, we have a pretty robust existing infrastructure when it comes to ESG integration. So integration meaning how we think about incorporating these considerations into a more traditional investing mold that's not necessarily impact investing, but just our base investment strategy. We as stewards and fiduciaries believe that we need to consider these factors in order to assess risk and then potentially also enhance return on a risk-adjusted basis over the longer term. So we think about ESG factors in every part of the investment process. That starts with investment selection and screening, where we identify high-level ESG performance and risks early on. Those risks are then communicated to the investment committee. They're budgeted for, both considering costs and potential savings in our financial models. So that's from an acquisition perspective. From a development perspective, we are ensuring minimum design requirements are met, and we're considering leading practices in design and implementation so that we're thinking about embodied carbon within the construction process. And then we embed sustainability requirements within our partner and contractor agreements so that they understand the importance and that's of these things to us, and that's part of how we're evaluating them. From an asset management perspective, our sustainability processes and requirements are also embedded into our property management agreements. From an operating perspective, so our sustainability practitioners and asset managers work with our property managers to ensure that the minimum requirements that we've set and advancement initiatives and opportunities as defined by our sustainable building standards, that each of those things are addressed. We include those expectations and initiatives into budgets and capital plans, and then we report on those expectations and initiatives via an annual sustainability survey, which comes after an auditing process to ensure correct implementation and interpretation and really implementation of each of those initiatives. So that set of sustainable building standards is really our primary method for advancing sustainability efforts across the platform, across the portfolio, and also for supporting external benchmarkings such as to the Global Real Estate Sustainability Benchmark, GRESB, for that assessment. And so we really try to standardize, we centralize our standards, communicate those to our asset managers, property managers, development partners, and so that we have a uniform code for how we're approaching sustainability, both risks and opportunities.
Mm-hmm. What are the opportunities you see driving ESG impact investment capabilities at Manulife?
The biggest thing I would say that we're focused on is our decarbonization strategies per asset. And so the vast majority of our full portfolio, more than half of the portfolio already has a decarbonization plan in place. And of course, we're looking at decarbonization as one element of a clean and transition over time that'll need to be supplanted by clean renewable energy on site. But step one is decarbonization plans. And by the end of this year, the vast majority of our portfolio will have decarbonization plans. So that's one example of how we're thinking about it within the real estate team. But there are probably a few other things that I might suggest that are occupying some consciousness today. So increased use of biogenic materials or grown materials that can sequester carbon. We have a timberland team within the private markets that is doing some really interesting work with respect to mass timber and carbon sequestration. And then when I look at the opportunity for mass timber, particularly and other modular Lego-like construction methodologies, I think I'm optimistic that one, they may support initial construction efficiency over time, but that they can also contribute to the circular economy, or where we focus on reusing and recycling materials to support sustainability, because those more modular like construction tools can be more easily dismantled and used in other buildings. Also optimistic about the use of more low carbon impact materials like net zero concrete or recycled steel. From a social perspective, I'm very pleased by the movement that we've seen prop tech solutions can offer, particularly those that can contribute to financial well-being of our tenants, like Susu or Boom, for example, or to prop tech solutions which report rental payments to the credit agencies and enable tenants to build credit. So that's another example that I'm excited about employing into more of our multifamily properties on our platform. And then last, I would say I am excited about the role of government in encouraging transparency. I know that a lot of the existing reporting requirements are under a lot of debate, and in some cases litigation. When we look at the SEC climate disclosure rules that were issued recently, or at sustainable finance disclosure requirements in the EU. But generally speaking, I think the role of government in incentivizing and encouraging transparency around the progress that is either being made or not made is incredibly important. And it's something that we track very closely as investors, because we want to be on the right side of that. You don't adhere to those, regulatory requirements, for example, that can produce some regulatory risk. So for example, in New York, local law 97 is in full steam. And we recognize that as investors, one, it doesn't make sense, or we don't want to be in a position where we're going to be fined that deteriorates our economic performance over time. So again, as responsible stewards, we're thinking about the risks here and then the opportunities that we can translate them into as we think about investing responsibly and investing sustainably.
Mm-hmm. So I want to flip the question. What kind of challenges do you see with the sustainable investing that you're working in?
I think the biggest challenge is the belief that fiduciary responsibility and societal responsibility is bifurcated. And so we as an industry need to continue to collect data to demonstrate the correlation between the positive correlation between long-term financial performance and also environmental and incorporating environmental sustainable considerations into our investment process. There's been more progress on that with respect to the environmental side of the equation. There are tools that are helping to collect data and report, but there's still a lot of question in terms of how that data is cut and universally reported. There's a lot more progress that we need to make on the social side of the equation, especially given that the social outcomes that I endeavor to affect are not outcomes that you can track over time or over an incredibly short term time frame. There's certain things that we can track in the short term, but ultimately what we're thinking about is generational change or generational positive outcomes. And so I can deliver a unit that is affordable today, and that particularly if I can deliver it in a high opportunity neighborhood that has access to great schools, that should yield to better long-term outcomes. But I need 5, 7, 10, 15 years to track that. So I think one of the challenges is connecting the short-term results with more positive longer-term outcomes. So there's work that we have to do in terms of that data tracking and really understanding longitudinally what outcomes look like.
You think that's just like the nature of Wall Street, just being like quarterly reporting, every quarter you have to, it's kind of hard to kind of meld those together, right?
It is. It's incredibly hard, but that is one of the things that we as mission-driven investors need to undertake in order to support more investment dollars into more equitable outcomes. So incredible challenge, but I'm up for it. And so, day by day, we try to make progress.
Yeah, that's super admirable. I was like reading some of your past interviews, and you were talking about you're like being driven by calling to support more equitable outcomes through investment strategy. I think, like you said, to be more intentional and deliberate. How is you and your team working to integrate that ethos in your work at Manulife?
Well, at its most fundamental level, it is the investment strategy and investment platform that I'm developing here in partnership with my colleagues in the real estate business, my sustainability practitioner colleagues. So I am working today to develop a cohesive strategy that focuses on both more equitable socioeconomic outcomes and more equitable energy transition, more equitable resilience strategies. So as I think about the potential for us within the built environment to support change, that's the essence of what I'm doing every day. Fundamentally, I think there is a generational opportunity for investors to make meaningful impact in terms of if we can facilitate greater levels of housing affordability, and we can think about supporting the built environment through all the things that communities need in order to thrive. So if we can deploy capital into underserved and undersupplied micro markets, because real estate, as you know, is it's hyper local. We think we can do that in a way that yields both market rate risk adjusted returns to investors, but also positive societal outcomes to a broader group of stakeholders.
Yeah, so is that kind of what Manulife's strategy was when they brought not only you, but like a bunch of, like, it seemed like really big names in real estate together to build out the new senior leadership team? So could you talk more about like the strategy behind that and how that all came to be? I know you mentioned earlier something about they wanted to focus more on like expanding their third-party management capabilities, but yeah, just wanted to hear it from you.
Yeah, so it started with the hiring of my boss. Mark came over from DWS, where he'd spent a number of years, and he came over in 2022 and really started working through a multi-phase repositioning of our business. As I mentioned, Manulife Financial Corporation has been around since 1887, and Manulife and they've been investing in real estate for probably 100 years. But still, our most important client was the balance sheet. We had moved into investment management, true third-party investment management, a number of years ago, but really Mark came on to accelerate that repositioning. So we outsourced property management. We brought in a new leadership team. I'm one of many new leaders that are part of the global real estate leadership team. We have a new CIO, a new head of capital markets in the US. We're building a private credit business, all exceptional leaders that I am incredibly motivated to partner with and that I'm learning a great deal from as we rebuild this new business together. And so really it's the pivot from having the general account be almost exclusive client to having them be one of many important clients as we really leverage what has already existed today in terms of the robust ESG infrastructure and level of ESG integration into the next phase of our business, which includes an impact strategy, which I'm working on, but other strategies that we think will meet the market where it is today and deliver market rate returns based on the compelling opportunities that we're seeing from certainly this disruption over the past couple of years within the broader economic environment, but that also recognize number of the trends that we're seeing going forward and thematically, impact and environmental sustainability, social sustainability is just one of those trends.
Mm-hmm. So what are the other key trends you see like really emerging within this focus of investing?
If we just take a step back and think about impact within a broader context, like if you follow the UN and their sustainability goals, for example, they just issued their 2023 Sustainable Development Goals report, and they recognize that there's a huge chasm with respect to the amount of private funding needed per period to meet the Sustainable Development Goal targets by 2030. So there's set of targets that have been set, and their estimate is that there is a $4 trillion annual gap, $4 trillion annual gap in meeting those targets by 2030. And so that gap is not going to be met exclusively by governments. Mm-hmm. The public sector is part of the solution, but the private sector has to be part of the solution as well if we are to achieve those targets. So I think just fundamentally, against that backdrop, we have seen encouragingly an increase in the number and average size of impact investment allocations in recent years, as investors recognize the urgency of participating in these better outcomes, but also as many investors like me, like Manulife, continue to articulate that we believe there's an opportunity to participate in those solutions without doing that in a concessionary manner. We, as market-driven investors, can be part of the solution in deriving better outcomes without giving up return. So it's the challenge, the opportunity, part of from a trend basis, why we think impact is one of the pillars that we need to continue to build upon as we move forward with our business.
So I wanted to go back earlier. You're talking about the social aspect. So yeah, I totally agree. I felt like when I first started in the real estate industry, it was like super opaque. It does still feel super inaccessible. I'm from California, so I've given up on buying a home anytime soon. But I wanted to you touched on this a little bit in your background. You're talking about HBS. You were a TWIGO fellow, and that really opened up your mind into like the different possibilities of kind of career roles out there. So I wanted you to maybe talk a little bit about what you're currently doing with the TWIGO Foundation and how you're really I guess paying it forward, right?
So I'm passionate about paying it forward in a number of respects. So I've been an alumni leader for actually since I graduated from business school. I've focused on supporting the foundation and giving back in many ways by serving as a formal mentor, as a peer mentor. But I most recently, or actually the past few years, I've served as chair of the TWIGO Alumni Endowment, which is about a little over $1 million that we have raised and continue to invest on behalf of alumni mission to support the foundation and in its ongoing mission to really change the face of finance. There's a bunch of stuff that I do separately that relates to other organizations, but I think it all falls into, where do when I'm outside the office, and as much as I can tie it to what I'm doing in the office, where do I spend my time and where do I spend my money? So my time is aligned with supporting the next generation of talent within our industry, particularly diverse talent that may not have had as many representations of leadership, of diverse leadership. So I feel a responsibility to do that, but I also get quite a bit of joy in terms of supporting people in reaching their potential. I'm one small part of that, but to the extent I can help someone think differently or make an introduction, spend a lot of time doing that, and then I make sure that I'm giving annually to TWIGO and other organizations, particularly that are focused on supporting really a widening of the funnel of the talent that this industry needs in order to move into the next generation. And so, Viet, to be clear, there's a connection between a moral imperative, but it's also a business imperative. Increasing talent in our industry, showing pathways to leadership and really being part of this network of social capital that historically many underrepresented minorities haven't had as much access to. It's both, it just makes economic sense. So it feels good to me personally, but it also just makes economic sense, I think, for my business and for our industry to make sure that we are increasing the funnel of talent at the early side, whether it is through the college level, at business school level, and that we're also thinking about the ways in which we need to not just recruit talent, but retain talent and support their development throughout the course of their career, so that we have a wider, deeper bench of strong leaders with diverse perspectives, right? And that's ultimately what this translates into. We are physical manifestations of those diverse backgrounds and perspectives, but when we can think about harnessing all of that perspective, that yields better outcomes if we can truly bring all of those diverse perspectives to the table and maximize our ability to see around corners by thinking differently, thinking bigger. So both morally driven, but also just super practical. This is the way that we succeed, by doing better by everyone.
Yeah, I think that's the way to look at it, right? You want everyone to be involved in real estate. Real estate should be representative of like everyone it serves. Yeah.
Yes, exactly.
Yeah, and that's really awesome. Well, I want to really thank you, Onay, for taking the time out to speak with me. This was incredible to hear your story, what you're working on, what you're doing with TWIGO. So I really appreciate you taking the time out.
Thank you. I appreciate it, Viet. And just in closing, I want to suggest, particularly for the students, right? Do you have to position yourselves to be contributors to the industry? So no excuses in terms of the study that you're doing at MIT, no excuses in terms of the work and the way that you need to show up in the organizations that you're working in, and soak in as much as possible from a learning perspective take advantage of every opportunity to learn and grow, build a strong foundation, a strong skill set, diverse skill set that enables you to move within our industry, not just up, but also allows you to pivot to other things that may develop over time, right? So just think expansively. Make sure you put in the hard work. That's obvious, but just we reinforce that, and then show up every day. But to do that with optimism, with a North Star that is, we need you guys to be thinking on another level, right? This is our ability as a society to think about what Gen X, Gen Z are bringing to the table to help us to push towards even better outcomes that baby boomers or those of me, Gen X, perhaps didn't even conceive of. So we need to hear your voices, and looking forward to seeing how you show up as you enter the workforce.
Thank you, Onay.
Thanks to our listeners for tuning into another edition of Meet the Visionaries podcast. And please remember to stay tuned for future episodes by subscribing to our podcast or follow us on social media by visiting cre.mit.edu to learn more. Until next time, take care, listeners.
Important disclosures. Investing involves risks, including the potential loss of principal. Financial markets are volatile and can fluctuate significantly in response to company, industry, political, regulatory, market, or economic developments. These risks are magnified for investments made in emerging markets. Currency risk is the risk that fluctuations in exchange rates may adversely affect the value of a portfolio's investments. The information provided does not take into account the suitability, investment objectives, financial situation, or particular needs of any specific person. You should consider the suitability of any type of investment for your circumstances and, if necessary, seek professional advice. This material is intended for the exclusive use of recipients in jurisdictions who are allowed to receive the material under their applicable law. The opinions expressed are those of the authors and are subject to change without notice. Our investment teams may hold different views and make different investment decisions. These opinions may not necessarily reflect the views of Manulife Investment Management or its affiliates. The information and or analysis contained in this material has been compiled or arrived at from sources believed to be reliable, but Manulife Investment Management does not make any representation as to their accuracy, correctness, usefulness, or completeness, and does not accept liability for any loss arising from the use of the information and or analysis contained. The information in this material may contain projections or other forward-looking statements regarding future events, targets, management discipline, or other expectations, and is only current as of the date indicated. The information in this document, including statements concerning financial market trends, are based on current market conditions, which will fluctuate and may be superseded by subsequent market events or for other reasons. Manulife Investment Management disclaims any responsibility to update such information. Neither Manulife Investment Management or its affiliates nor any of their directors, officers, or employees shall assume any liability or responsibility for any direct or indirect loss or damage or any other consequence of any person acting or not acting in reliance on the information contained here. All overviews and commentary are intended to be general in nature and for current interest. While helpful, these overviews are no substitute for professional tax, investment, or legal advice. Clients should seek professional advice for their particular situation. Neither Manulife Investment Management, nor any of their affiliates or representatives is providing tax, investment, or legal advice. This material was prepared solely for informational purposes, does not constitute a recommendation, professional advice, an offer, or an invitation by or on behalf of Manulife Investment Management to any person to buy or sell any security or adopt any investment strategy, and is no indication of any trading intent in any fund or account managed by Manulife Investment Management. No investment strategy or risk management technique can guarantee returns or eliminate risk in any market environment. Diversification or asset allocation does not guarantee profit or protect against the risk of loss in any market. Unless otherwise specified, all data is sourced from Manulife Investment Management. Past performance does not guarantee future results. Manulife Investment Management is the brand for the global wealth and asset management segment of Manulife Financial Corporation. Our mission is to make decisions easier and lives better by empowering investors for a better tomorrow. Serving more than 17 million individuals, institutions, and retirement plan members, we believe our global reach, complementary businesses, and the strength of our parent company position us to help investors capitalize on today's emerging global trends. We provide our clients access to public and private investment solutions across equities, fixed income, multi-asset, alternative, and sustainability-linked strategies such as natural capital to help them make more informed financial decisions and achieve their investment objectives. Not all offerings are available in all jurisdictions. For additional information, please visit manulifeim.com. This material has not been reviewed by, is not registered with any securities or regulatory authority and may, where appropriate, be distributed by the following Manulife entities in their respective jurisdictions. Additional information about Manulife Investment Management may be found at manulifeim.com/institutional. Australia, Manulife Investment Management Timberland and Agriculture Australasia Party Limited, Manulife Investment Management Hong Kong Limited. Canada, Manulife Investment Management Limited, Manulife Investment Management Distributors Inc., Manulife Investment Management North America Limited, Manulife Investment Management Private Markets Canada Corp. Mainland China, Manulife Overseas Investment Fund Management Shanghai Limited Company. European Economic Area, Manulife Investment Management Ireland Limited, which is authorized and regulated by the Central Bank of Ireland. Hong Kong, Manulife Investment Management Hong Kong Limited. Indonesia, PT Manulife Asset Management Indonesia. Japan, Manulife Investment Management Japan Limited. Malaysia, Manulife Investment Management M. Berhad, 200801033087. 834-4424-U. Philippines, Manulife Investment Management and Trust Corporation. Singapore, Manulife Investment Management Singapore, Part Limited, Company Registration Number 2007-09952G. South Korea, Manulife Investment Management Hong Kong Limited. Switzerland, Manulife IM Switzerland LLC. Taiwan, Manulife Investment Management Taiwan Company Limited. United Kingdom, Manulife Investment Management Europe Limited, which is authorized and regulated by the Financial Conduct Authority. United States, John Hancock Investment Management LLC, Manulife Investment Management US LLC, Manulife Investment Management Private Markets US LLC, and Manulife Investment Management Timber and Agriculture Inc. Vietnam, Manulife Investment Fund Management Vietnam Company Limited. Manulife and Manulife Investment Management are trademarks of the Manufacturers Life Insurance Company and are used by it and its affiliates under license.